Hello?
You turn it down a little bit.
It's a little loud.
Okay. And try to do it one more time.
Hello?
Hello. Better.
That's fine. Yeah.
Hello? Is this better?
Good afternoon. We are the University of Montana CFA Institute Research Challenge team, and we will be presenting to you our sell-side analysis of Banner Corporation. Our team made a buy recommendation with a target price of $67.79, which represents a 24% upside for Banner's current value. This figure here shows our direct target price versus Banner's prices from February of 2017 to February of 2020. Our team identified three key factors that we feel led to Banner's undervaluation, the first of which being they have a geographic advantage from being located in the Pacific Northwest, which is one of the U.S.'s highest contributors to U.S. GDP. Another way that they strengthen their position in the Pacific Northwest is through a series of strategic acquisitions, and their loan diversification also has contributed to their growth.
Banner Corporation is a bank holding company that falls in the financial service sector. They operate in the regional bank industry, and they are headquartered in Walla Walla, Washington, with 178 full-service branches and over 2,000 employees. Their primary business activities include originating loans and accepting deposits. They are currently traded on the NASDAQ trading platform. And on January 19th, 2020, when we did our valuation, they were trading at a stock price of $54.87. A couple of company highlights are Banner Corporation's recent acquisition of Alta Pacific Bank in November 2019. They were ranked highest in the Northwest for retail banking satisfaction from J.D. Power and Associates. And they were also ranked in top 100 best banks by Forbes. From 2008 to 2018, Banner's assets grew at a cumulative average growth rate of 9.93%. As of September 30th, 2019, they had over $12 billion in assets, which is an $8 billion increase from 2008. And in 2019, total interest income and net interest income increased.
So Banner's lending activities over the past 10 years have increased substantially. From 2008 to 2019, it grew at a cumulative average growth rate of 7.91%, from $3.8 billion to about $9 billion. You can see here from our figure from the company fact sheet that the company mostly specializes in commercial and agribusiness loans. Their deposit portfolio has also grown at a cumulative average growth rate of 8.86%. This figure shows the distribution of growth between 2015 and 2019 of their loans and deposits, and this is a deposit composition breakdown as of 12/31 of 2018. Over the past couple of years, Banner's business strategy has been centered around mergers and acquisitions. This is a few of the companies that they have absorbed into their business model since 2015, and management's main goals are to be top quartile in these categories. For our industry analysis, we first took a look at demand for commercial banking. Large recovery in consumers since the financial crisis has led to an increase in demand for banking. We next looked at the unemployment rates. Unemployment rates can affect banks by impacting the amount of deposits that they can bring in. Less people that are employed means less money coming into the bank. The FOMC projects a slow increase in the unemployment rate nationally over the next couple of years, and the Pacific Northwest normally experiences higher than average unemployment rates, so we think that this will negatively impact their value. The federal funds rate is also very important to banks as they profit off of the spread that they make between their loans and the interest they pay out to customers. The FOMC projects that the federal funds rate will rise throughout 2022, but Trump's trade war and slowing economic growth has caused the Fed to cut rates 3 times in 2019. A decrease in interest rates results in decreased profitability for banks. This is a figure from the Federal Reserve Bank of Atlanta that shows the probability of 25 basis point rate cut with the blue line, and the green line is a probability of a 25 basis point rate hike. And as you can see, the probability of a rate cut is much higher in the short term. Banner currently operates within a middle market niche because they have all the benefits of being a large financial institution while still focusing on a very customer-centric business model. There are a few of Banner's contributing economic growth factors to the Northwest. Our Porter's Five Forces analysis shows that the banking industry has low to medium risk in all categories except threat of substitute products, which is high risk because switching costs between banks are very low right now and technology is increasing.
Since 2017, Banner has increased its net profit margin. This is about a 99% increase. In the past year, their asset utilization has fallen. However, compared to industry leaders, their other percentiles have fluctuated the same way as theirs have. Banner has about a 90% earnings base. Their earnings on total assets as well as earning assets is above peers, as well as a 1% spread advantage, meaning that they're also receiving more interest than they're paying out on debts and deposits. Certainly, their efficiency does have room for improvement. Banner has a burden ratio of 1.68 compared to the industry average of 0.52. Ideally, and in very rare cases, banks want this number to be 0 to in the negatives. This simply means that Banner has more overhead costs than they do non-interest income. Going off of this, in the past 5 years, Banner has made several acquisitions of other financial institutions. As you know, efficiency requires technology, and technology is expensive. And so we see this opportunity for economic scale as an opportunity. We chose to do 3 different valuation models, the first of which is a discounted free cash flow, a free cash flow equity, and an industry multipliers, multiples valuation. Some of the assumptions we made, while the FOMC does in the short term project that interest rates will decrease, in the long term, they expect rates to stagnate or rise through 2022. Because of this forecast, we expect that Banner will continue to grow its revenues. We used a 20.5% efficiency tax rate as per current regulation. As far as our weighted average cost of capital calculation, we used a 10-year treasury rate of 1.78, a 10-year or a 5 monthly beta of 0.75, and a equity premium of 8.02. We, as you can see, for all of our valuations, all of them hold potential upside for Banner stock, and we weighted each one based on what we found were relevant. Based on our industry multipliers, we use PE, PB, and our PEG ratios. We use PEG and our PE ratios because they show expectations for future growth in the industry, and price to book, as it is a relatively stable and intrinsic metric to compare to stock price. For our free cash flow to equity, this resulted in a stock price of $77.81. This represents the cash flows available to shareholders,
contributors, and to maintain appropriate risk capital. Like other banks, Banner poses many risks that may adversely impact their operations. In the future, we suggest Banner's management to focus on credit risk and interest rate risk, as we feel that these will have the largest impacts on their valuation. And to summarize, there are many opportunities for improvement with ratios. There's an upside with each valuation, and there's high regional growth, which is why we recommend a buy recommendation with a target price of $67.79 and a 24% upside. Thank you.
2 seconds to spare.
So just kind of trying to hit on maybe the interest rates. You guys kind of noted to maybe 2 to 1 cut coming up this year. Did you guys do any stress testing looking back at maybe the great financial crisis and how profitability was affected by rate cuts?
We did not do any stress testing. We were thinking that the cuts in interest rates would lead to decreased profitability because of what we saw during the financial crisis and rate cuts, but we didn't do any like official stress testing.
And then, I was kind of looking at in 2019, we saw 3 rate cuts and that decreased profitability by over 0.25% for the net interest margin. Do you expect that to be kind of parallel, or if we do see a couple more rate cuts that would decrease margins?
I imagine with more decreases that we'll see further decreases in margins. I guess we'll see.
Okay, I was going to ask about slide 7. You guys talked about the business description by lines or the loans that they have. What about, and you touched on geography, what about loans by geography? What did you guys find there?
Well, we didn't look much at loans by geography. We looked more at their overall loan portfolio and the percentages that they contribute to each different type of lending. So we looked more at what their lending practices include. So we didn't look very much at geographically.
Okay, gotcha. And then last 2 more. Slide 9, you guys mentioned that management said they want to be the top quartile in all of those areas on the bottom there. I guess, where do they stand presently?
In our presentation that the company gave to us before we did our research, they talked about how that they were in the top for everything except their return on assets currently, and that was what they were focusing the most on, because that was the only thing that they weren't top quartile in.
Okay, gotcha. And then one other one before I hand it over to William. You mentioned an acquisition on slide 5. Do you know what they paid for that acquisition? It was the most recent one here, the Alta Pacific Bank. I guess, do you know any metrics around it, like the size or what they paid on a multiple of book or anything?
I think they paid a little bit over $1 million, but I'm not sure what it ends up being.
I know that they gave up like 0.2 to Banner shareholders to Alta Pacific's shareholders in that acquisition. I don't remember what exactly the price was that they paid for the acquisition, but
Okay.
that was the ratio.
Yeah, so it was a share transaction. Okay,
In
great. Thank you.
addition, it also increased Banner Corporation's assets by $2 billion. And you did see that from year 2019 and on, those numbers were based off of consolidated statements from Banner and Alta Pacific.
Okay, great, thanks.
So in your guys' presentation, you mentioned that kind of post-financial crisis that there's been a number of bank closures, which is spot on, that's accurate. But what's another factor that could possibly cause any bank closures beyond now that we're 10 years out of the banking crisis?
Yeah, absolutely. So certainly regulation, especially you'll see that on smaller community banks, the cost of regulation is certainly higher. And that's why you're seeing a lot of mergers and acquisitions between these community banks. And then why these community banks are compared to a really high, it's $12 billion to $250 billion is their the standard industry group that they're compared to. You can see that the ratios aren't going to compare as well because they need technology to be efficient. And so a lot of these mergers, acquisitions, and closures are happening because they essentially need each other to become, they need those economies of scale.
Do you think that younger people bank differently than, say, somebody Colin's age?
Absolutely. People are able to do mobile banking on their phone. They're able to deposit checks
Yeah.
on their phone. They can trade online, they can do investments online. Everything is so technologically driven now. But that's what us as consumers want in that.
So then my second question is that, so if you guys were the CEO of the bank, what would be an ideal interest rate environment for you? In terms of making the most profits?
They definitely would want to see interest rates rise over time because that would increase their profitability. So I think as a CEO, you would want to see the rate cuts stop now. If it, anything, so.
And then this is kind of a timely question. So, yeah, I understand they're a U.S. kind of smaller regional bank, but can you think of any way that they would be affected by the coronavirus?
We talked a little bit about them being in the Pacific Northwest, how big companies like Amazon that are based out of Seattle rely very much with their business with China. So the impacts on the supply chain, if they're bigger than what we are projecting, it could really negatively affect businesses in the Pacific Northwest, specifically Amazon. So that could impact banks because people who work for Amazon are banking through Pacific Northwest banks. So
What do you think would happen to interest rates if this pandemic kind of continues? Would it make interest rates increase or decrease or stay flat?
I project that they'll probably decrease, just to help lubricate the economy and pump more money into the economy, to at least get us through this hard financial time.
So that could be a headwind for them over the next couple of quarters.
The advantage that you're to.
We'll loop back around if you guys have more problems.
Yeah, slide 17, your weighted average cost of capital. I'm just curious how you got the cost of debt.
Yeah, absolutely. So our line of thinking is that the role of banks as a financial institution is lending in, so they are 90% debt finance. And so we included their deposits as part of their, as part of the rated, as part of our calculation. And so this drastically reduced our weighted cost of capital, as well as FDIC insurance helps subsidize the cost of banks as well.
So out of curiosity, and I don't have the balance sheet in front of me, but excluding deposits, what's their cost of debt? I mean, I'm assuming they have some other debt outstanding.
Yes, so this was with deposits. Without it moved to about a 3.46%.
Okay.
And then because we have a very low weighted average cost of capital in our free cash flow to equity model, we have a relatively high equity premium. And so it completely avoids this whatsoever. And so you can see both perspectives.
Thanks.
Then one last kind of macro question. How do you guys see regional banks performing versus like large banks or just the general U.S. Market?
well, regional banks definitely have a disadvantage because of like brand recognition, especially with young people getting more into like technologically based banking. They're going to rely a lot more on banks that they know have like a good reputation versus a small regional bank. There's not a lot of incentives to go with your small regional bank anymore when Bank of America is offering you the same stuff with more technological benefits for you as a banker. So I think we'll see definitely a lot of more mergers and acquisitions from regional banks being sold to larger banks and absorbed into their business models. But I definitely know that being from Montana agribusiness, they put a lot of like trust into their personal bankers. So regional banks have a lot of opportunity with rural areas and especially like agribusiness.
That's about time right there.
Yeah, ladies.
Nice job,
Good
guys.
job.
Oh, sure.